Market risk and diversification. Condense the money, condense the risk. It's a risky business, honey. An IncomeLuxe.com lesson. To understand market risk, you really need to get how the market works. Over the last 30 years, an increasing amount of funds are index funds, which purchase the whole market. Additionally, many funds buy an extremely specific group of stocks. When the market is expanding, money is increasingly deposited into these funds, which buy sets of stocks. That drives the entire market up and hypes everything. So, the whole market moves up together. The same is true in reverse, men and ladies. When the market takes a dump and people start panicking and pulling their money, they sell out their fund stakes and take their cash and move the hell out. This means the funds have to sell to meet redemptions, requests to remove money from the fund, and they have to sell the market. The whole market, so all the stock moves down together just like it moved up together. Condense capital, condense risk. This applies to markets and portfolios. Why the hell am I talking about this? Every stock has its own fundamentally driven risks, and the market risk. Both of those move the stock price. You can have a fundamentally great stock but the market sucks today. You can have a fundamentally trash stock but the market's awesome. If the market's tide is coming in, it lifts all boats. If it's going out, it'll sink all boats. Fundamental risk. Each stock's isolated risks can blow up in your face in a day. If the stock's fundamentals are trash, or the CEO dies, or the sales are half what they should be, expect price to go down. If it's the only stock you own and you put your whole brokerage account in it, when it goes down 50% you actually screw this, let's just make a table of what happens if a stock goes down 50%. If a stock is 100% of your portfolio and falls 50%, you take a 50% portfolio loss. If you had $100,000, it'll be a $50,000 loss. If a stock is 25% of your portfolio and falls 50%, you take a 12.5% portfolio loss. If you had $100,000, it'll be a $12,500 loss. If a stock is 1% of your portfolio and falls 50%, you take a 0.5% portfolio loss. If you had $100,000, it'll be a $500 loss. See? Looks like you shouldn't put all your money in one thing, right? Here's the issue. You can diversify away fundamental risk, but you cannot diversify market risk. Always diversify fundamental risk. But the market will always lift most boats, and it will always sink most boats. Very rarely will the market go down 4% in a day but your stock goes up 6%. If you're lazy, just buy an index ETF and you will only be exposed to market risk, as most fundamental risk will be diversified away. You can, however, control market risk by using a concept called hedging. Hedging is great at killing market risk, but there's a concept called beta you got to understand first. We'll cover that after the example, for premium and site members only. An IncomeLuxe.com lesson summary. Market risk is the rise and fall of the market together. This is driven mostly by mutual funds, index or sector ETFs, and hedge funds. Many people deposit and withdraw together. Stocks are driven by both stock risks and market risks. Buy and hold many unrelated stocks to reduce stock-specific risks. These stocks will still be driven by market risks. You can potentially hedge out some market-related risks. This lesson is provided free of charge by IncomeLuxe.com. IncomeLuxe is a financial social club for those who want more. We introduce you to over 140 online income streams. We also provide 150 investment, finance, economic, and business lessons for social club and website members. Members get paid commissions for anyone they refer who buys a monthly, quarterly, or annual subscription. To learn more, join us at IncomeLuxe.com or Skool.com/IncomeLuxe.